Very good evening and Happy New Year to each and every one of you for being with us today in this evening. So we would like to take this opportunity to thank you for your continuous support to our business partner, Alliance Bank, and also to our Affin Hwang World Series Global Disruptive Innovation Fund. So as we survive a challenging 2021 last year from all the market headlines, looking forward for a better 2022, the market has once again given us a challenging start the year. So even Katie Wood from Art Investment has also posted a video a few days earlier, emphasized that we are in this together. So my name is Lam from Affin Hwang Asset Management. I'll be your moderator today. Throughout the session, feel free to post your question to the chat box. We will try to group all the similar questions together and get the speaker to share us his view. So today, we are glad to have Darius from Nikko Asset Management, and he is currently managing a team. Oversees the key relationship in the Asian region. So Darius will be joining us today to give us their perspective on the macro events and updates on the Global Disruptive Innovation Fund. So before we move on, Darius, do you have a few words to share with our audience today?
Thanks for this, Lam. I hope you all are all hearing me loud and clear. You stole all the good lines already, so I'm just probably going to reiterate again that, again, to all the clients, Happy New Year as well. And we hope that you guys are all keeping safe. As soon as maybe Malaysia and Singapore, we have more vaccinated travel lanes and we can travel a little bit more freely. We hope to be doing this in person somewhere down the road. So that we can travel down, and meet with all of you rather than just being online as well. So in the meantime, stay safe and looking forward to our discussion over the next 1 hour plus. Yeah.
All right, thank you, Darius. So let's just begin the session with the bigger macro questions over to you. As we notice, I think our inflation has spiking to like a 40-year high at 7%. And with the Fed is also making a hawkish pivot on its policy to tame the inflation. So what is your expected 10-year treasury yield and the expected rate hike for this year, 2022? And do you see the possibility that the Fed is doing a reverse on their hawkishness policy in this year?
Well, I think this is a very difficult one to call, right? Especially because now we're only day 13 of the year. But nonetheless, you see a lot of the major banks, especially the US counterparts like JP Morgan and all that, they've all jumped onto the bandwagon to essentially say, yes, we're in a situation where we need to be very, very prudent. We need to cool down the acceleration of the economy. And obviously, this will not be news to people anymore, but they are already, forecasting a 3 times, 4 times hike, possibly within this year itself. So if you take at minimum, right, they raise 25 basis points each time, that means you're looking at easily a 1% increase, so on and so forth. So obviously, this will have a longer term impact, in terms of all the 10-year treasuries and all that you mentioned. But our point of view is not so much to debate whether or not it's going to be 3 times, 4 times, or maybe even 5, 6 times. And we are not so interested in whether it's going to be 25, 50, etc., etc. But when we look at the whole economy as a whole, right? And this is talking about global economy, maybe even Asian economies, Malaysia, Singapore, etc. What we noticed is that it's a very interesting problem right now, because while you're talking about inflation and the need to raise interest rates in the US, the reality is that's because it's a very US-centric problem. Now, if you take the contrast, for example, and the big giant to contrast would be China, or even if you want to take the 3rd largest economy, which is Japan, obviously we are a Japanese-owned entity as well. You can see that the 2nd and the 3rd economy in the world, they are not in a very much inflationary kind of a situation like the US. And in fact, China has already said that they are potentially going to relax some of the monetary policies and all that. Now, this doesn't mean that they won't continue regulatory concerns around stocks and shares, around certain investment, but make no mistake, China is still trying to grow the economy and is still at a pivot point, right, where it can continue growing at a much faster rate than a lot of the Western counterparts. Similarly, when you look at Japan, right, as the third largest economy, whenever the US goes into this period where they want to raise interest rates, you know, they want to tighten up against inflation and all that, and quietly, if they don't say anything, Japan is actually the largest benefactor of all of these things that are happening, right? Because as economies slow down and all that in the US, it is the quiet guys like Japan that actually gets a bit of that pickup and a bit of that returns as well. So I think first things first is that there's no uniform application of this impact of rising interest rate across the entire industry. But I guess specifically to our event for today, the real concern will be, you know, between growth stocks versus value stocks, right? And obviously, you know, technology, innovation, disruption, and all that. These are pretty much more growth in nature rather than value at this point in time per se. But you know, obviously, everyone is then concerned, like, hey, if they're going to cool down, this means that it's going to cause your stocks and shares, your sector, to have an even greater devaluation over the course of this year. So I think one has to be very, very cautious, Lam, that when you're thinking about, you know, rising interest rate, will this uniformly affect everyone? I think the answer is no. And I think as we go along this discussion, you will also see that, you know, with specific examples to many of the technology stocks with disruption, innovation, a lot of all these companies are not going to be the ones that are directly hit first, if you see where I'm coming from, compared to, say, for example, you know, the banks or real estate companies and other sectors. Yeah. So I hope this kind of gives you a bit of a background that we are not all that concerned when it comes to this particular segment at all with regards to rising interest rate per se. Yeah.
All right, thank you, Darius. So I think as you mentioned, like, means aside from China, well, I think, do you see the current inflationary pressure to ultimately moderate by the end of this year?
Right. So this obviously is then linked to the first part of your question, right? If the inflationary pressures reduce, then yes, maybe we will see less rate hikes. We will see less urgency for the rate hikes. And I think one then has to go into the argument of, do you believe, are you in the camp where, you know, you think that inflationary is transitory? Transitory means temporary. Or are you one that thinks that inflation is permanent, is going to be here to stay? And I think what sent a lot of mixed signals to all of us as investors was sometime end of last year, where Jerome Powell, before he was re-elected as the Fed chairman, he was cited by saying, no, it's going to be transitory. The next thing, he got elected and he says, yes, it's problematic. So we got to hike more times. So he sent a lot of mixed signals, which is probably why clients are asking this question. But if we were to dissect some of these things along the way and look at the component bits. So for example, one of the key worries about inflation, obviously, is all the shortages. I'm going to put them in a nutshell, but shortages come from anything from chip shortages, to oil shortage, coal shortage, and things like that. So while it's definitely going to cause a bit of concern and it's going to cause some prices of goods and services to spike in the short term, right? We do have a belief that this is going to be temporal rather than a permanent thing. Now, let me just use coal and energy as a good example. These are some of the items that are very, very worrisome right now, really, because in the cold countries where they have winter and all that, these guys need all these commodities to essentially, heat up their house, so on and so forth. But frankly speaking, if the governments, are mucking it up, for example, in Europe or in China, this problem will persist for maybe a month or 2 or 3 months at the very most. Then what happens? You're going to have a change in weather. And once you have a change in weather, the demand for energy, for coal, kind of like goes down. People will still be unhappy, but there's no real inflationary concerns, if you see where I'm coming from. Now, if you take from last year hangover to this year, chip shortages was something that people also complain quite a fair bit about. But if you really narrow down onto the chip shortage, right, 2 things essentially happen. One, those companies that were able to secure chips, although they secured it at a higher price, these were guys that were able to then pass on the cost to the end clients. So anyone who was able to upgrade your computer last year, buy a new handphone or whatsoever, you would also notice that the prices went up, right? And that's because companies with pricing power were able to do so. But yeah, at the same time, you have the other end of the spectrum of consumption, where you go like, okay, well, if I can't buy my car this month, I think I can still use my car for a while. I'll wait a little bit longer. Or even if you have no choice but to wait a little bit longer because your supplier says, sorry, Lam, I can't deliver you the car in 3 months. I got to deliver to you in 6 months. You really got no choice. You just have to wait. But once you solve that consumption ticket item, right, it's not like you're going to buy a second car, a third car, and a fourth car, so on and so forth. So really, is this going to be a longer term problem? We don't think so. We think it's going to work itself out. Now, the one shortage, though, that is very, very interesting in many parts of the world, though, is some of the labor shortage. So obviously, you can see from the fact that, in the US, right, a lot of people decided to quit their jobs because of poor wages, so on and so forth. Even among the tech companies, they're talking about, people poaching their staff and all that. There's talent shortage and all these others. Again, we think that this is going to be a bit temporal because in the laws of demand and supply, long story short, once you're getting a bit of shortages in some of these areas, companies immediately know that they need to respond. They either need to raise wages, they need to hike all these talent pool monies and all that. And as a result, you're going to get that supply coming back in. And to a certain point in time, you might get oversupply, right? But at the same time, what this means is that people's wages going up means that they can actually feed and fund that potential inflation if it really happens as well. So on an ongoing basis, we don't think that this is such a big concern because we think this will work itself out in terms of the supply and demand things. But obviously, if you're saying, is it going to be an impact next week? Is it going to be an impact 1 month? Sure, short term, there will be a crunch. But over a long period, 3 months, 6 months, 9 months, 1 year, we think this will even out by itself. Yeah.
All right. Thanks, Darius. Well, I think last year what we have seen a lot is the tug of war between the rotation of between growth and value stock. Yes. And do you still see a high dispersion in valuation between growth and value this year? And will we continue to see the rotation between value and growth?
Right. So maybe in answering this question, especially because it pertains to disruption as well as innovation, let me just highlight that, yes, there will still be this dispersion between growth and value, but also really because the definition of growth and value has changed quite a fair bit over the last 3 to 5 years. Now, allow me to take a step back and share with the audience here. Now, 3 to 5 years ago, if you were investing in companies, you would have called Apple, you would have called Amazon, all these companies a growth company. Back then, 3 to 5 years ago, your value companies will still be Shell, Esso, Mobil, JP Morgan, the traditional. Any tech person or tech company that's closest to value or a stable play might have been Microsoft, for example, right? But fast forward today to 5 years later, the issue is a lot of all these companies that used to be growth stock have now become mainstream. So when you think of the likes of Apple, when you think the likes of Google, Alibaba, Tencent, etc., they have all become very mainstream stocks. And why is this important to share is because when you saw the collapse in terms of valuations towards the end of last year, there was this whole terminology where everyone was flight to security. Now, when you have flight to security in the past, and bear with me on this, the benchmark, right, used to be a lot of banks, a lot of all these oil companies and all that I talked about. And so when clients used to run for safety, they were buying banks, they were buying all these traditional commodity companies, so on and so forth. But last year, when people were running to security, they were actually running to all these tech names, to all these tech companies. And as a result, you saw the valuations for Apple, Amazon and all this just shoot up through the roof. And the frank thing now is all those guys, they are growth in nature, but very mainstream. They are now on 50, 60, 70 times price to earning. But who are the real growth stocks per se, right? Are some of the names that we own within our portfolio. And some of all these names, right, have been very unfairly beaten down to the point where we are even contemplating and calling them that they are value, and in certain instances, just to borrow Kathy's words, they are even deep value. Because some of all these companies like, the biotech companies that we own, some of all these 3D printing companies and all that we own, they are not even in 20, 30, 40 times multiples. Some of them are as low as teens or low teens multiple, right? So Lam, I hope this gives you and as well as the audience a little bit of appreciation. I mean, yes, there's still going to be this disparity simply because the world now thinks a little bit different. And when they think of flight to security, they are running to all these growthy names like Amazon and all that. But where else, some of all these names that usually were associated with growth are now becoming value. And that's why the dispersion has happened last year. And we think that it's going to continue this year, unless we see a correction in some of all these stable tech names. And then people start to realize that, hey, there's a need to rotate back into some of all these cheaper names. Then you will see the gap between value and growth start to close up again. Yeah.
Right. Thank you, Darius. It seems like, I think 2022 still looks like a challenging time for equity market. So how do you see the sector of disruptive tech?
Right. So I think the disruption technology is facing a lot of headwinds, not because of the companies themselves. So it's a lot of rumor mongering, it's a lot of hearsay and all these other things. But where we like to just quell the picture, for instance, is this, is to remind everyone what it means to be disruptive, what it means to be innovative, per se, when it comes to our strategy and when it comes to our thinking. So first things first, when we are looking at the companies that we own, we're really studying the technologies that's behind it. So everything from the AI, the energy storage, the robotics, so on and so forth. We're not really looking at what the companies are doing, like Apple, Tencent, and all these others, because to us, those are, formerly innovative, but they are no longer innovative today. And they may or may not be, relevant in 3 years, 5 years down the road. Sure, they are massive companies, and don't get me wrong, I'm not trying to predict that Amazon and Apple and all this will crash, but we're constantly asking ourselves, are they helping to further certain technologies? Are they helping to further certain innovations? And if they are, then they qualify as our criterion for what it means to be disruptive as well as innovative. So Lam, you're absolutely right. I think it's going to be a challenge because in the eyes of the mainstream investors, now that everyone is familiar with Apple, everyone is familiar with Amazon, which again, I have to say was not the case 5 years ago, 7 years ago. Everyone is comfortable to hold them because thinking that they are the next blue chip stocks like the banks, so on and so forth. And where people are afraid to hold the next innovative stocks will be the things like Tesla, will be the things like Zoom and all that we are currently holding. But frankly speaking, make no mistake, one day these guys that we are currently holding will also become very mainstream. They may be added to indexes and so on and so forth. And that means that institutional investors will have to own them and all that as well. It will come upon a time where we will decide we need to out some of all these guys. And then we've got to look for the next, Tesla, the next Zoom, the next Square, so on and so forth. So I think it's always going to be a fair bit of volatility, if you like, when it comes to disruption and innovation kind of stocks and shares. So we're not predicting that even after 2022, what you will see is a nice straight line with no volatility. But really investing in this asset class, right, you will always have the naysayers and all that. I mean, if you think about just taking a step back with things like alternative vehicle transportation, it was not too long ago, 2-3 years ago, where people were still debating about electric vehicles versus hydrogen vehicles and all that. And while this is still an ongoing debate, right, and perhaps we will live in the days where both type of vehicles will be, in existence, the reality is you're always going to have this tussle between people thinking that this is right, this is wrong, and you will never be able to solve the mystery altogether. And that is such the world that we live in when it comes to disruption and innovation. The only thing that we hope we can do is on the longer term basis, buy in at the right time, sell at the right time, and be able to rebalance our portfolios so that we can make monies for the clients at the end of the day. Yeah.
Right. Thank you, Darius. So like from what you mentioned, there's a lot of opportunity in the market. And given that as a long-term mega trend, disruptive will continue to be a strong theme. And with all the rotation happening, I think even some are talking about market reopening post-pandemic and the more cyclical play coming. And how do you see the volatility on the fund this year?
Right. Again, a very interesting and obviously pertinent question because honestly speaking, from 2020 to 2021, when the fund did very, very well, it was off the back of a lot of COVID plays, as people call it. And obviously then, in 2021, when we didn't do so well, this question was already surfacing like, is it because our stocks are no longer relevant in a post-COVID kind of a play, you know, and so on and so forth. And so this is where we wanted to just say that we think that a lot of investors, when they first heard about the reopening of markets and things like that, they have a bit of a knee-jerk reaction. And we think that over time, they are going to find that it was unnecessary in terms of how big their reaction was going to be. So one example that we like to use in portraying this is the company called Zoom. Now, obviously, Zoom during COVID period, it surged like crazy in terms of the account opening, the usage, so on and so forth. But one of the key things when it comes to our strategy as well, disruptive innovation, we often say this, and Kathy is the one that champions this sentence. She says that it is an industry where winner takes most. So if you think about all the different apps that are out there, Zoom, you know, BT, Meet Me, whatsoever, right? Google's Teams and all, Microsoft Teams, Google Meetups and all that. You have to admit, I mean, at least I think this is the case, and I'm not trying to be biased here. The rest of the audience members can chime in, but I do think that Zoom has the most user-friendly interface by far among all of them. So what this means is that most people are defaulting back to Zoom. So in the early days where Zoom had all these struggles, you know, with regards to privacy and all that, yes, a lot of people started to use other platforms and all, but even today, I'm starting to see a lot of other distributors for that matter and business partners, they are starting to relax on that. They say, oh yeah, okay, no need to use Cisco, WebEx and all these others, we can use Zoom. So what it means is that Zoom is becoming that dominant player. Now, the question about usage though is also very muted because, I mean, I'm going to give my example in Singapore. We are now slowly going back to the office. So if you're following some of the Singapore news as well, up to 50% of the workforce is now encouraged back to the office. So I am personally going back to office every Monday, Wednesday, and Friday. Now, reasonably, that means that my Zoom usage should drop by 60%. But Zoom doesn't give me a 60% discount on my subscription just because I'm going back to the office. So from the reality perspective, right, what has changed? Nothing much. Everyone used less Zoom, but Zoom still makes money because we are all still paying that same amount of subscription. Now, if you think about that and you apply that down to all the different things like media, you know, media entertainment like Netflix, you know, and one of the companies that we own in our portfolio is called Roku. It's exactly the same thing. You have bought the set-top box from Roku, you're paying the subscription, so on and so forth. Just because now you're not at home to watch as much as you used to because you got to go back to the office, doesn't mean Roku give you a discount. So that's what we mean by a knee-jerk reaction. While a lot of all these things are going to be great from the going back to normal perspective, and people are worried that such stocks and shares will suffer, the reality is they won't because they've already secured you on a subscription basis, model, so on and so forth. And for that matter, precisely because people are now going back to offices and all that at a staggered rate, staggered timing, what this also means is Zoom still is very important. Because I don't think I will ever get all my team members in the office on the same day at the same time to host a meeting. So even if I can host a physical meeting, I will still have to have an option of Zoom for those who are not there. So again, Lam, I know this has been a very long explanation because I wanted to rope in quite a number of things to show and demonstrate. But what we wanted to say that with the reopening, we think that there's going to be just more opportunities still. There's going to be still consistent usage. The knee-jerk reaction and fears initially are not something that we think will persist in the longer term. Yeah.
All right, thank you, Darius. I'm glad that you also covered a little bit about Zoom because Zoom was the share price also quite concerning to some of our investors. So I guess since you have touched on some of the holdings, then why not we just move into more specific questions into our funds?
Sure.
Well, perhaps I think you could briefly share on the thought process that goes into stock picking for the fund. Yeah. Whether will there be like a tactical stance will be adopted to reduce the exposure of the underperforming stocks, and maybe also to add what would be your recommended investment horizon to this fund, right, and why?
Okay, thanks for this, Lam. So I guess one of the, perhaps I'm guessing a little bit here, one of the key reasons why this question was probably asked is that people have this misconception that, you know, fund managers, sometimes when we buy into a position, we wait and we hold, right? And so even if we're wrong, we will tend to stick with that wrong call for a while until it proves to be disastrous before we sell out and all that. But I want to allay everyone's fear on this call that, you know, Kathy and her team are not like that. They actually are very, very active traders. So if you are also monitoring them on the ETF basis and all that, on the ETF basis, they demonstrate that every day they sell and buy all these stocks and shares. And because our strategy is mirroring their ETF, right? We are also buying and selling. And the best part is we're doing it in real time. So it's not that Kathy is selling first, then we start to sell at a worse price and all that. Our fund manager that's trading this particular fund is actually based in New York in the exact same time zone as she is. So every morning when she has decided her trades for the day, she actually emails it to Nikko Asset Management, and then we will simultaneously execute the trades at the same time, right? So hopefully this gives you appreciation as well that first and foremost, they are not being lazy and just sitting there on stocks that are underperforming and not doing anything. Now, in terms of strategy, Lam, because a lot of the stocks and shares, right, have been bought over a period of time. So I know that, again, this question probably comes from the media where a lot of times, right, some of all these naysayers, they will publish a clickbait kind of an article or clickbait kind of a video to say, oh, Kathy is buying more of this stock and share because she's got to shore up the price, so on and so forth. Now, if you have heard Kathy before in person, and this is even before 2020 when she has had that phenomenal run and all that, essentially she always tells people, number one, she is a very deep contrarian, right? What that means is that when everyone is running into the stock as the share price is going up, she's actually selling. So she has a long history, and Tesla is a very good example of that. When in the early days of Tesla, when no one believed her, whenever the share price goes up, she sells a little bit. But whenever it drops, she's buying heavily, and so on and so forth. So once you think about that, I mean, it's actually the right way to invest, right? You buy low and sell high, not sell high and buy low. So this is exactly what she's doing. And so when she looks at some of all these companies that have been beaten down quite a fair bit, you talked about Zoom, there's Teladoc, and a few of these others, she basically feels that these stocks and shares, which are supposed to be growth in nature, have now entered what she calls deep value territory. And so if she's convinced of the technology, she's convinced about what the company is doing, this becomes buying in opportunities for her. So all we need to do is also be a little bit patient to give those stocks and shares the time to rebound and all that. And that's where we will start to see the fruits of our labor as well, both from a fund manager's perspective, as well as from an investor's perspective for being patient. But so hopefully these two things, one, she is trading quite actively. Two, she's looking for constant opportunities to rebalance and buy into stocks and shares. Gives you guys comfort that she's doing a fair bit for the portfolio. Now, the third one though, that I wanted to share is in terms of where her actual positioning and exposure is coming in from. So this goes back a little bit as well, but it's just to showcase to you that she's actively looking again. From 2019 coming to 2020, back then, our most active position was around 3D printing. Now, because of what we anticipated was going to be a lockdown and all that, during that pivot from 3D printing and industrials, we actually started buying a lot of media and the so-called COVID beneficiary kind of companies and sectors. And true enough, that happened. And when she ended up pivoting from 2020 into 2021, she felt that the pivot was going towards genomics. And unfortunately, in 2021, that has not really fulfilled its potential because we went into a much extended lockdown, far more than most people anticipated. But at this current point in time, there are still a couple of genomics names that she feels are very, very attractively priced. Again, using that value, that terminology that she says, deep value. So she is still holding on to those convictions as well. But yet at the same time now, there's a double whammy because some of all these COVID positive stocks have seemingly been abandoned by the marketplace. But to her, she's still looking at all these stocks and saying they are going to be very relevant, and she doesn't understand why the market is selling them down. So she's taking that opportunity to snap back some of all these stocks and shares again in positioning for them to rebound in 2022. So at the moment, I think our positioning, if you like, hopefully this answers the question, is pretty much set. We're still holding on to some of those companies we think that the marketplace has ignored from a genomics and all standpoint. And yet at the same time, we think that some people have overreacted on the COVID positive by selling them out. And we are still, having faith, keeping the belief that these are very important companies going forward.
Right. Thank you, Darius. I think from what you shared just now, I think you briefly touched on a few names like Roku, Teladoc, maybe we would like you to share some insight as well, why the fund manager is so bullish on all these stocks and continues to add on to them, to the share, while the share continue to drop like from a year ago.
Right. So again, I think one of the key things that we've been saying is that when a lot of all these, and again, this is not trying to criticize anyone. I mean, everyone here has the right to disagree with us as well. But I think a lot of the lay investors, especially if you're just buying the stock and share yourself, right? One of the key things that you look at is the number of subscribers and the number of accounts being created, that growth. Right. So up to a certain point in time, right, people will say that, okay, Teladoc, Roku and all that, they had that huge expansion in the number of users, but thereafter it's tapering down. That means that the revenue that's going to come from these people and the expectation of further growth is going to drop and is going to dip. Now, I feel that that is a very erroneous observation, because if you think about a parallel company called Apple, Apple doesn't own the leading market share in the world today. In fact, Android, right, over the iOS has more users. If you think about the number of handphones and all that, Samsung is the one that sells more handphones than Apple. But yet, Apple is the trillion-dollar company and so on and so forth. Why? Because they've been able to build that ecosystem and sustain that ecosystem, even though they don't have the most phones sold and the most users out there. So likewise, when we talk about things like Teladoc and all, now Teladoc started out, right, before COVID, with single-digit client base, right, using telemedicine. Because back then, everyone just goes and queue up and all this. But throughout this whole 2 years, they've actually jumped that number of online purchasers, right, up to 30%, 40%, and is now even well into the 60s and fast approaching 70% number. Now, what this does is it will alter people's behaviors completely. Just to give you an example, abstract, not related to Teladoc, but even in Singapore, 2 nights ago, my daughter was having fever. What did we do? We ordered online fever medicine and the fever patch, and it was delivered that very day itself at 9 p.m., right? So we don't even have to rush out to go to the pharmacy anymore. And so this is the convenience that I think a lot of the investors who are just looking at sheer account opening and all that, right, they're going to miss out, because it's a continuous usage. I may have said this to this group of investors before, but it's worth repeating as well, that 4 or 5 years ago, I started ordering groceries online. I have not been to a supermarket in the last 4 to 5 years, simply because of the convenience. I don't carry the tissue paper, toilet paper and all that. So this is where we're coming from. With Teladoc, this is already the demographic change, the usage change and all that. Now, how does that then evolve into a P&L contribution, right? Is that going forward, Teladoc is also looking at the number of centers, the distribution centers in terms of shops that become a little bit redundant, because most of the clients maybe in those areas are buying medicine online. So if that's the case, what they can do is they can close those physical shops, right? They can save on the rental and everything and consolidate everyone back to, for example, a warehouse. Now, if this sounds familiar, that's exactly what Amazon did, right? Amazon has 0 shops, but they operate everything out of warehouses and all that. And Teladoc has that option. So you can imagine across the nations, what they will do is create such centers, and then all their people move from front end to the back end, and then they just do telemarketing and just sell all these things out online and so on and so forth. Now, similar with Roku as well. So Roku, and I mean, in that stream of thoughts, you can think about people like Disney Plus, you can think about people like Netflix and all these others. Just because we all go back to work, just because everyone already has an account, and there's going to be a tapering off of new account creation and all that, doesn't mean that there's no longer any value to those companies. Neither does it mean that there's any less value, with regards to the growth, so on and so forth. Because it'll come upon a time when most of us are using it, right? And guess what? Netflix will say, sorry guys, we're upping your subscription by $10. That's how they grow their revenue. So obviously we all hope that doesn't happen. But this is what we mean, Lam, that in the short term, when you just focus on the growth of new accounts and all that, you're going to miss out that these companies have already captured you into their ecosystem, and you are going to continue using their services, whether there's COVID, whether there's no COVID going forward. Yeah.
Right. Thank you, Darius. Well, another question is that I think many of the companies in our portfolio have a pretty lofty valuation, lack of profit, lack of cash flow, which does not give much downside protection if the companies do not deliver. So how do you manage the downside risk for this case?
Right. Actually, I feel that this question is a little bit untrue, you know, Lam, because when maybe in the early days of 2015, 2016, when ARC strategy was first founded, it could be true that back then they were supporting some of all these other companies that back then were not very well known and so on and so forth. But today, I won't say, okay, I mean, in terms of lofty valuations, yes, one or two of our companies, for example, like Tesla, right? Tesla's valuation has just kept shooting across, you know, the stratosphere and all that. And ironically into space, pardon the pun. Okay, but I think the reality is when we look at our analysis, and this is where the deep dive comes from Kathy, at whatever valuation they are at right now, they are still well below what she thinks is a fair value even for the company. So she's not buying into something because the growth or the valuation aspect is there. At the heart of it, right, may I just take this opportunity to remind all the investors that in order for a stock to make it into her portfolio, she does have the baseline expectation, and this is through all her experience, working out the numbers and everything. She expects the companies to double their share price in the next 3 to 5 years, which means that she expects them to compound annually 15 to 20%. So at this rate, she still thinks that Tesla is able to do that compounding because it has not reached its full potential yet. Now, with a lot of the other companies as well, as a result of last year's correction and all that, they are no longer anywhere near their lofty valuation status, as well, I'm trying to say. And so, in fact, some of them quite the opposite. They've reached this situation where they can be considered deep value. And again, this is something that Kathy has said a lot in some of her interviews online, etc., etc. And where we basically see some of all these companies, and I said it's untrue, is because we are not investing in companies that are startups, or we're not investing in companies, for example, in the genomics names. This is a common misconception. We're not investing into them when they are at phase 0, phase 1, or phase 2. Most of the time, the companies that we're investing in are already in phase 3, which is production phase, or phase 4, which is full sales and distribution phase already. So as a result, there are P&L, there are quite a fair bit of data out there that shows these guys' revenue, their cash flow, so on and so forth. And earlier on, I made a comment about rising interest rate and all that, not specifically affecting this particular segment quite a fair bit. It's because at the end of the day, many of all these guys also, they don't have huge debt on their book. That means they are not issuing a lot of bonds and they don't have a lot of debt servicing, which requires them to then make more repayments as interest rate goes up. A lot of all these guys, they are either backed by venture capitalists, private equity funds, fund of hedge funds, and things like that. So there is still a lot of privately owned monies behind a lot of all these companies. So with regards to this, right, I think that I wanted to just say, and hopefully this has allayed some of their fears amongst the investors here, that all these companies are not, close to being bankrupt or collapsing in the next 1 to 2 years and all that. But in fact, they are quite sustainable companies, and we expect them to be, constantly still improving. Now, reason being, again, it's a case where in disruption and innovation, winner takes most. So we've invested in the best of all those companies. So if they are the ones that are going to collapse, it's very unlikely because their competitors will likely collapse first before these guys actually collapse. Yeah. So Lam, I hope that gives you a bit of perspective with regards to this question.
Right. Thank you, Darius, for that. Well, let's just move slightly away from US. Let's talk about China tech. I mean, China tech has a major whiplash in 2021. We believe that this has indirectly affected the stocks within the portfolio of ARC. So how will you see the situation pan out moving forward in this year or moving forward?
Right. So I think one of the, just to correct that thinking a little bit, we didn't get so much of that whiplash effect. In fact, we benefited from that because as most investors here will be very aware, our weightage in China is actually very low. So in fact, all through 2020 and 2021, we got a lot of questions from people, why aren't you adding to China, right? And the reality was we were looking to add to China. However, we were one of the foremost people talking about the fact that we worry about China regulation. So true enough, in 2021, when Chinese regulations stepped in and it curtailed quite a number of all these companies, we were actually vindicated. Now, that's not to say that we are pumping our fist and we go like, yeah, we're right, so, and all that. No, but in fact, we're looking at China very, very closely still, and we're still trying to make the best sense of things, because we're also very cognizant that when it comes to technology, when it comes to disruption, it's going to be a case where not only winner takes most, it's going to be very geographically dominated. What do I mean by that? If you look at, say, for example, in Malaysia, I'm not sure what is the leading ride-hailing app. I know at one point it used to be Uber. Am I right to say Grab is probably the leader, or is it Gojek or something? Grab? Is it Grab? Okay, in Singapore, it's Grab, yeah? But if you go to Indonesia, it's Gojek, for example. If you go back to the US, it's still Uber, right? And obviously, if you go to China, it's something else altogether. So what we're saying is that when you talk about some of all these things, and this is important also because of things like EV. Now, EV Tesla has obviously gotten the first mover advantage. So they will probably be the dominant player in the US. But as you can see right now, China is also developing all their own EVs and all that. And while we like Tesla, we're going to say that at some point in time, we may have to back some of the Chinese winners as well, right? Because it's such a big market there. Now, not only that though, when you think about the European counterparts, right, is Mercedes, BMW, Volkswagen, going to just sit down there and say, all right, we surrender the EV market, Tesla, come, take over our market on the EV segment. They won't. They will create their own versions, and then that will be the popular version that will be in Europe and all that. So what we're trying to say here is that two things. One, the regulatory regime in China has definitely dampened our mood to charge into China, to start adding to names, simply because we don't know when the next trigger is going to be. But we're really going in to understand them a little bit better, see who are the really long-term winners, and understand which are the companies that are perhaps a little bit more in line. So this means that, you know, going into China, talking to a lot of all these asset owners and trying to find out, first and foremost, where is their stance on common prosperity, for example. If you're going to get someone who is, you know, one of those business owners of a tech firm who goes like, I don't believe in common prosperity, then there's going to be an issue. Those are obviously companies that we're not going to invest in, because they are going against the Chinese government's, you know, kind of a policy and future direction. But once again, once we get a sense of where the companies are going, how they are trying to back the government in terms of their overall goals and ambition, this gives us a lot more comfort to then start to go in and back some of all these Chinese companies. Obviously, all things withstanding, they have to be market leaders. They have to be the ones that have the most sound technology, and, you know, they have the ability to double share price in the next 3 to 5 years, so on and so forth. All these applies as well. Yeah.
Right, thank you, Darius. Yeah, also I think we have a local audience confirm. I mean, the question you said, it was Grab in the local. All right. Let's move on to some external factors. I think we have seen, like, we have recent launch of a short innovation ETF like SARKUS. I think that delivers the exposure to the actively managed art innovation ETF. So what's your take to it? Will that impact the fund? Will affect them outflow or even selling pressure? Especially, I think follow with this year, I think we have underperformance against the broad market.
Right. So I think what we really don't have an answer to say, you know, that they are going to be right, they're going to be wrong, because obviously, you know, as this last 2 to 3 years prove, there are times that we are going to be so right that, you know, they are going to be so wrong. You know, but yeah, at the same time, there are times that maybe just because of our timing and all these other things, we are wrong. And at that moment in time, they seem to be very clever and very right. But, and again, we don't want to comment on them in terms of what they are doing per se and all that. Sure, I believe that they are doing their own analysis, so on and so forth as well. But maybe just focusing on what we are trying to do within our fund, the strategy, the fund managers, day-to-day operations and all that, right? I want to just give everyone the assurance a lot that Kathy, she's very, very diligent. She's always looking at the companies, understanding them. You know, she even tells us at certain parts of the year, she doesn't want to do presentations and all that because she is doing its earnings seasons, for example, and she wants to focus on studying the company, so on and so forth. And at the same time, every Friday, you know, she is doing talks. She has this so-called work group talk, and it's actually open to people who are in the States as well. And this is where they not only have their fund managers and analysts in the call, they also get external scientists, they get external engineers and all these others to come in and talk about technology, to talk about the direction of travels with regards to what is happening in the technological space, who are the companies that are advancing certain things on what front. So I really want to say, and I'm not trying to be biased here, but amongst many of the fund managers that I've really spoken to in my entire career, she's really plugged into the technological aspect about all these companies. And so as a result, right, I can only say, Lam, that in the short term, yes, there could be multiples of other factors that work against her and drag the stock down. I mean, short selling is a very simple example. When people don't understand what's going on in the company, they just call for shorting of the company. But for her, because she understands it so well, she knows where it's going, it strengthens her conviction to double down or to buy in the dips. And she knows that at one point in time, it's going to be right. She's going to get the rebound. She's going to be able to so-called laugh in everyone's space. So I would say that, obviously, now clients have to decide, right? Do you take the easy way out and, just go with some of all these guys who are obviously bashing her because she's famous and all these others? Or would you really want to, continue to back her, knowing how much hard work and all that she's really putting into understanding the stocks, understanding the funds and all that? So I would say that on her side, I can tell you, whenever we pose this question to her, her answer is very standard. She says, I'm not even worried about what they are doing. I'm only focusing on what I'm doing to make sure that in the longer term, which is 3 to 5 years, I get my calls right. And that's all I'm trying to do. Yeah. So yes, in the short term, some guy going onto YouTube, blasting the stocks and shares, calling for everyone to sell, that might lead to a short correction in the few days or few weeks. But in the longer term, we think that that's not going to be sustainable. Investors are going to get smart. And by investors, I also mean all the other fund houses, institutions, etc., etc. There will be a time where all these things will reverse in the right directionality of travel as well. Yeah.
All right. Thank you, Darius. Well, the next question, I mean, we got this question all the time. You should know what's coming. So what's your opinion on cryptocurrency and Coinbase, while many governments do not support this?
Right. So we have two answers to this. The first answer is the more conventional answer. And the second one is a bit of a conspiracy theory answer. Okay, so let me do the conventional answer first. We think that in the short term, yes, some countries are obviously struggling to understand it and coming to terms with it, really because maybe they don't have a technical understanding and, short of saying that they're not smart enough, but really they don't see how this could benefit their economy. But even say, for example, Singapore, right? Singapore were not outright banning it, but obviously some of the country governments and all that, they're thinking that, look, we may need our own version of a cryptocurrency, a digital currency, so on and so forth. So Singapore is one that's developing and all that. But over time, what we'll see is there's probably going to be alignment because all in, right? I mean, with crypto and essentially blockchain technology, everything is limited to a certain extent. And so at one point in time, you're going to be traded something that's limited, something that's fiat, something that's limited again. There's going to be some kind of regulation around the whole thing. So we think that at some point in time, some of all these countries, that have actually rejected Coinbase or rejected Bitcoin and all these other things, they are going to come to a much better understanding of it. And at some point in time, they will have to allow it. Now, the conspiracy theory is that, because a lot of all these countries, they're not ready yet and they're not understanding yet, they're just rejecting it so that it doesn't come in, while they go behind the scenes and they develop their own, right? So once they develop their own, they are able to compete effectively, so on and so forth. So I think this is something where obviously you have to decide which side of the coin you belong to. But I think if one really takes a step back and tries to understand the overall landscape, one will have to be very honest to admit that at some point in time, like it or not, cryptocurrencies are going to be here. Whether or not you believe in it, it's going to be something that's solely up to you. But in that same token, right, Lam, what we often do is we take crypto and we compare it to gold. Now, gold has been here for the longest of time. And for the longest of time, people also always say gold is limited in the world, right? But the reality is you and I, we know that there's gold, but do you also invest into gold? So crypto, we think is going to be one of those things as well. It's going to be there. Whether you believe it, you understand it, you like it, you don't like it, if you choose to, you will get exposure to it. If you don't, it's just going to be one of those things that you never buy. So for that record, I know about gold, but I don't own gold funds. I don't own any gold pieces, gold bars whatsoever, right? And so this is something I think I just wanted to put it out there that we think this is still a developing space. It will truly get more and more important as time goes by as well. But as of now, we think that, with the larger base, fiat currencies, and all these other things, there's still a lot of optionalities to invest in, even if you don't believe in this crypto and this evolution of all these digital currencies.
Right. Thank you, Darius, for a very long answer. Well, I think we let's move on. Like, what would be the biggest risk that you expect for this fund in 2022?
Right. So I think the biggest risk in 2022 for us is for governments to go back. Okay, so two things. Largely, it's not so much to do with the companies per se, but really is what governments are going to do. So for one, obviously, we're all now battling with this possibility of the Omicron variant. Now, if governments do not handle all these upcoming variants and all these other things well enough, I think then that's going to be a potential long-term problem, because it means delay in opening of economies, people cannot travel, life per normal per se is going to be dragged out, and it's going to possibly cause us to go into year 3, or even, fingers crossed, not year 4 of what COVID is all going to be about. So that's one of the biggest threats. I think the second biggest threat with regards to technology has always been government intervention. So in 2021, we saw that in China per se. Now, we always said that US and all that has a largely more friendly environment for technology, for innovation, which is also why that is our natural bias in the portfolio to own more US stocks and shares. But that's not to say that we're only looking at US stocks and shares. So I think over the next 1 year, we are already seeing many governments, many economies trying to open up this whole digital innovation, kind of a landscape. Like I mentioned to you, the real reason is because in the end of the day, a lot of all these technologies and all are going to become very localized rather than have one big global player dominate everything. All right. So because of that opening up, though, I think this is going to be causing a lot of unevenness in different parts of the world. So regulations will struggle to keep up in terms of how liberal we want it to be, how lax we want it to be. A lot of dressing will still be taken from perhaps leading players like the US, China, Japan, Europe, and so on and so forth. But by and large, we obviously feel that this is where the room for human error comes in. Because if certain regulators feel that, no, this is not my priority, I want to clamp down on this, then you might see certain stocks and shares be affected in the near term, right? But over time, we do think that the directionality of travel is going to be to allow for all these things to develop. Now, the key reason is because of the ESG focus. The key reason is because we're all talking about sustainability, save the world, so on and so forth. And at the heart of what disruptive innovation actually does is trying to provide for solutions, and is trying to provide for things to be done in a more efficient way, in a more eco-friendly way, so on and so forth. So frankly speaking, disruptive innovation is trying to solve many of the problems of the world today for the future. And as a result, we feel that yes, even if there's going to be a blockage in the next 3 months or in the next 6 months, that's not going to be a blockage forever. And over time, we as stock traders per se, we will just play the market so that we can trade and get into the stock and share as and when we can see those opportunities as well. So that is the biggest worry for us. The second biggest worry, obviously, is that if the world continues to be as frightened as it is last year, coming into this year, then you might still see a lot of people hang on to their safety stocks that I mentioned earlier on. And these safety stocks will be your Apple, Amazon, so on and so forth. But the reality is when you look at all those companies, for a safe company, they are very high up on the valuation curve. So we are questioning, those valuations. And, obviously, if these safety stocks start to take a tumble, and it could tumble from anything because of, interest rate rising in the US, so on and so forth. And a lot of it is just sentimentally driven. Because frankly speaking, what is Apple doing? Apple is going to do what Apple does. Next year, or this year rather, make new laptops, make new handphones, come up with a new iOS. Next year, same thing. They're going to do the same thing, come up with a new watch and so on and so forth. So fundamentally, what changes in Apple? Nothing. But Where the share price is going to be, up or down and all that, is all fundamentally driven by investors' emotions and reactions to certain news in the regulatory environment. So this is where we feel, again, if this is going to be a continued year where growth, or rather those sustainable, those mainstream tech stocks are going to be, then we might see a slightly prolonged period where these stocks and shares that we own suffer a little bit more. But the answer at the end of the day, we feel, is these guys are going to take a reversal, right? Say what you like, Apple is not a company that's saving the world from monogenetic diseases. The guys down here at, teens PE is. And once that happens, these are the guys that should rebound. Yeah.
Right. Thank you, Darius. It sounds like the drop is more like a temporary.
Yeah.
Right. I think the next question is, I think a lot of our clients will always want to hear it for your advice. I think our clients have invested at the peak, and I think as of today have suffered more than 30% drawdown on the fund. And those clients have been very supportive. They have bought up 2 to 3 times since, and continue to see the portfolio come down further. So what is the expectation and your advice to the client? Should they topping up further?
Right.
Or to just hold on to it? Yeah.
Thanks, Lam. This is always a very, very difficult question. And once again, like Lam, I want to just express my thanks as well as appreciation for all your support. I know it's very, very difficult to bite the falling knife kind of an effect. But essentially, if your investments was 40% down and you've averaged down, at the bottom, and what that means is that you probably are maybe 20-30% down now. I would say that, based on what Kathy always says, where she expects 15 to 20% return, this year we should be able to climb back up and get you back some of those returns. Now, I'm very hesitant to say that we're going to rebound and break even, okay? Because once again, 2020 coming to 2021, that 150%, that was a very abnormal year, all right? It was really an abnormal year. Of course, we hope that that repeat will come again. Can that repeat come again? Yes, highlighted by all those things that I mentioned to you earlier on. Broad-based market takes a tumble, our things go up. You're going to see that happen, very, very quickly if that's the case. Because again, in the peak of our fund performance, the problem is while we are running up to 150%, you will see us go up 10% one month, drop 10% another month, go up 10%, and so on and so forth. So on that way up to the 150, we had a lot of volatility as well. I mean, if you speak to your bankers, they can pull out some of their historical records to showcase to you. But going forward, though, we're going to say that, similarly, it's going to be volatile. But hopefully this time around, we'll see more volatility towards the upside rather than the downside, so that you can recover your funds a little bit quicker. Right, so do bear with us. The worst thing you could do now, and to be very, very honest, I just scolded one of my friends yesterday because my friend, he lost faith. So he took that 30% discount and he sold out of the fund, right? And I asked him, so now that you sold out, what are you going to buy? And he says, don't know, wait and see. Right, so it's the same situation. I hope that clients, you're not going to sell out now, and ask yourself, and you look around, and frankly, there's nothing else to get into, because once you look at valuations, this is still the most logical thing to buy, because valuations are not demanding within this particular asset class. So if you're going to buy low, sell high, these are the low assets that you're talking about right now. And we hope that you will endure with us during this period. Now, whether or not, as Lam's suggestion to add more, I think this one, I will leave that discussion to you and your banker. Now, I think if you're really trying to desperately average down, I also want to then make a word of caution that you got to place this portfolio, right, in context of your broader base portfolio. If this is already, 30, 40, 50% of your allocation, which I don't think it is, I think then all the more you shouldn't add to it, right? You should just stay with that weightage. But obviously, if you are, one of the higher risk, or you can tolerate more risk in your portfolio, and you're willing to reallocate because maybe the other opportunities within your portfolio are looking less attractive. For example, like global fixed income or Asian fixed income. Yes, maybe you can trim some of all those to then, move it towards this fund and then wait for that rebound as well. But again, like I said, I think the best conversation is to speak to your bankers so that they will be able to give you that holistic advice and put this in perspective of your portfolio, which I don't have the visibility on. Yeah.
All right, thank you, Darius. Well, I think we are reaching the 1 hour mark, and you have done your presentation right on time. So I don't see any more questions in the chat box as well. I think if any of the clients have any more questions, feel free to always reach out to your relationship managers or bankers, and they will always able to post the question to us, and we will always share our insight. What do we think, Nikko Asset Management think about the fund? Right. I think thank you very much, Darius, for your time today, spending your evening with us, and also thank you everyone who dialed in tonight. I think this is evening, so dial in today. So any last word to say from you? I mean, last word from Darius.
Right. So, of course, I mean, I hope that, after hearing all of this, I just want to be very honest. I also own the fund. I've taken that ride up with you together. I've taken that pitch down into darkness as well. And at times I ask myself, it looks like this, this little pot, a little bit empty, a little bit, dismayed looking. But I hope after what I've shared today, you'll feel a little bit more confident, you'll feel a little bit more relief. And as what Lam says, right, if at any point in time you have any questions, right, please feel free to come to us. And then, we hope that we can journey together and change this empty pot into something that's a little bit more fruitful and will bear fruit for your portfolios as well. So if we don't get to go to Malaysia and see all of you in person anytime soon, I want to just take this opportunity to wish everyone Happy Chinese New Year as well, because we wish you Happy New Year. 新年快乐，万事如意, and please stay safe, stay healthy, and I look forward to the next seminar where I can interact with all of you again.